Most financial planning revolves around a single, highly personal goal, making sure you don't run out of money before you die. You calculate your expenses, invest for growth, and hope your portfolio survives as long as you do. But if you reach a point where your personal retirement is fully funded, the math changes. You start looking at the surplus capital sitting in your accounts and realize its purpose extends beyond your own lifespan. Passing that wealth down to the next generation introduces deep friction. Estate taxes, volatile market cycles, and poor planning can erode decades of hard work before your heirs ever see a single deposit. To bypass that friction, some investors turn to participating whole life insurance savings plans, specifically structures like the Promise4Life Century Milestone option. It's designed specifically to warehouse capital and transfer it cleanly. Committing to a generational structure requires a sharp mental pivot. The capital you put here ceases to be a tool for your lifestyle. It becomes an instrument entirely for someone else. This diagram maps out why consumers buy the wrong insurance product. It happens when they misunderstand the destination of their money. Look at Path A. If you might need this capital for daily expenses, medical emergencies, or vacations, it requires liquidity. For lifestyle needs, Promise4Life offers forever income and assured-term income for regular payouts. Path B is different. This capital is designated to survive you. You lock it away to be inherited as a massive, tax-efficient windfall. Purchasing a legacy-focused product to solve a personal retirement income problem is a devastating, irreversible financial error. You have to know exactly which path you are on before you sign the contract. Let's look at how you actually fund a Century Milestone policy. It operates on a front-loaded premium payment term. You compress the entire funding of the policy into a short, aggressive window, typically 5, 7, 10, or 12 years. This requires intense cash flow early on. If you commit to an annualized premium of 1 lakh rupees, you have to hit that exact mark every single year until the payment window closes. You can choose to break that premium down into monthly or quarterly payments, but the insurer applies modal factors that make non-annual payments slightly more expensive. Paying annually is the most efficient way to input capital. The goal of this compressed schedule is to create a fully funded, self-sustaining policy while you are still in your peak earning years, completely eliminating the burden of premiums later in life. This structural design demands absolute certainty in your short-term cash flow. You are trading current liquidity for long-term security. This chart tracks the timeline of a typical legacy scenario. Here, a 40-year-old investor funds a Century Milestone policy over a 10-year term, targeting a maturity age of 100. Notice the base input. The premiums climb for 10 years, hit a total of 10 lakh rupees, and then completely flatline. The capital input stops, locking the principal inside the insurer's participating fund. From there, the primary growth mechanism takes over. The insurer declares annual reversionary bonuses. These slowly and silently compound over the decades, adding value to the death benefit without triggering any taxable events. At the very end of the timeline, the secondary growth mechanism triggers. The terminal bonus is a massive, one-time payout awarded only if the policy reaches its ultimate maturity date. We have to separate marketing from reality. The towering numbers you see in brochures are projections based on an assumed 8% market return. The strict, ironclad guaranteed sum assured sits much lower. While the compounding timeline works well, the ultimate size of the family legacy depends on the insurer's multi-decade market performance exceeding the base guarantees. The starkest trade-off of a whole-of-life legacy policy is the absolute lack of liquidity. There are 0 interim survival payouts and 0 annual cash bonuses distributed to you. There are exactly 2 guaranteed trigger events that release the capital: the death of the policyholder or the policyholder reaching 100 years of age. If you hit a financial wall, a medical emergency, a business loss, or a child's wedding, and try to pull this money out early, you will face extreme friction. The only way to access partial liquidity without destroying the policy is to take a loan against the surrender value. That loan immediately incurs an active interest rate penalty, further reducing the final payout. A legacy plan is a deeply selfless financial instrument. You deliberately build a mountain of wealth that you are structurally prevented from enjoying yourself. we have to address what happens if unexpected financial hardship interrupts your premium payment term. If you miss a payment in the first year and fail to correct it within the grace period, the policy falls into a lapse status. Your insurance cover immediately ceases and you receive zero benefit payout. Total loss. If you've paid for at least a full year but miss later payments, the policy enters a paid-up status. The policy stays alive, but the final payout is permanently crippled, and it completely stops accumulating future reversionary bonuses. The insurer does offer a 5-year revival window to reinstate your full benefits, but it requires paying all your back premiums plus simple interest on the missed amounts. If you choose to surrender the policy entirely before maturity, the financial loss is steep. The surrender value is often significantly less than the total premiums you paid, especially in the early years. These plans brutally penalize a lack of financial discipline. If your income is unstable, committing to this structure is highly dangerous. The participating Century Milestone Plan is a highly specialized tool. It is not for everyone. The ideal candidate meets very specific criteria. First, they already have a fully funded personal retirement portfolio. Second, they have a highly reliable surplus of short-term cash flow to feed the initial premium window. Third, and most critical, they have absolute certainty that they will have zero need for lifetime liquidity from this specific block of capital. If you are trying to build a hybrid approach, hoping to leave a legacy while also keeping the option open to use the cash for your own golden years, you must pivot. Standard index funds or an income-focused insurance option are a better fit. The value of legacy planning comes from a willingness to permanently dedicate capital to the generation that follows.